The math of aggressive mortgage payoff only works if you ignore opportunity cost and liquidity risk. Let me show you what Patricia actually gave up. Her mortgage was $320,000 at 4.2% interest. Her monthly payment was $1,570, including principal and interest, but not taxes or insurance. Over the last 5 years, she paid an extra $1,000 per month toward principal, trying to eliminate the mortgage faster. That's $60,000 in extra payments over 5 years. If she had instead kept the mortgage on schedule and invested that $60,000 in a basic S&P 500 index fund at an average 10% annual return, she would have approximately $78,000 in liquid investments right now. The air conditioner breaks and she writes a check from her brokerage account. Done. No new debt, no emergency. But she does not have $78,000 in investments. She has $60,000 in equity she cannot access without friction. She saved roughly $13,000 in mortgage interest by paying early. She gave up $18,000 in investment growth to do it. She lost net worth and she lost flexibility. And this assumes she never needs the money for anything else. The moment she has to borrow against the house to cover emergencies, she is paying new interest that erases the savings from eliminating the old interest. A 2022 analysis from Bankrate found that the average home equity line of credit interest rate is 7.2%. Patricia just paid off a 4.2% mortgage so she could borrow at 7.2% to fix her air conditioner. She is paying more interest than she was before, just in a different form. This is where it gets really dark, because the liquidity crisis doesn't stop at emergencies. It extends to opportunities you cannot take. Patricia works in marketing. She's been at the same company for 8 years. Last month, a former colleague offered her a partnership in a consulting firm that requires a $35,000 capital contribution for 20% equity stake. The firm is solid, the opportunity is real. Patricia cannot do it. Her net worth is $693,000, but her liquidity is $18,000, and she cannot drain her emergency fund to invest in a business. If she still had a mortgage and had invested that extra $1,000 over 5 years, she would have the liquidity to write the check. Instead, she has to watch someone else take the partnership slot, because all her wealth is trapped in drywall and roof shingles. The equity doesn't help her. It just sits there while her career stagnates. And if you think she can just get a home equity loan for the opportunity, you're missing how those work. Banks give you home equity lines for home improvements and debt consolidation. They don't love funding business investments with home equity, because if the business fails, you default on the house. Getting approved for a business purpose HELOC is significantly harder than getting one for a new deck, and the rates are worse. Patricia has equity, but she does not have capital. Those are not the same thing. Now I know what you're thinking. Bobby, you are telling people to stay in debt forever. You are saying mortgages are good and paying them off is bad. That's insane. And I hear that. But here's what I'm actually saying.